Welcome, everyone. Good evening for those of you who are on EST time. Thank you for joining. My name's Elisa Douglas. I am Director of Alumni Engagement and Programs at Columbia Business School. Welcome to our first CBS Faculty Live Virtual Talk. So this virtual series brings our CBS thought leaders to you no matter where you're located. And in just a few short moments, we are going to hear from our speaker, Professor Abby Joseph Cohen, on the election consequences for the global economy and financial markets. Her talk tonight will discuss the potential consequences of the recent US November 5 elections, how that affected economic policies, global economic performance, and financial markets. This is a highly anticipated talk, and we have over 600 alumni that have RSVP'd to be here and hear from her. So before I hand it over, I just want to share some very quick housekeeping. Professor Cohen will present first, and then we will open it up for Q&A. During this portion of the program, we encourage all of you to use the Q&A function. Please submit your questions for Professor Cohen. So now, without further ado, Abby Joseph Cohen is Professor of Business in the Economics Division at CBS. She was previously a long-standing partner and Chief U.S. Investment Strategist at Goldman Sachs. She was also president of the Global Markets Institute at Goldman Sachs, which provides research on the intersection of economics, public policy, and financial markets. She began her career as an economist at the Federal Reserve Board in Washington, D.C. Professor Joseph Cohen, you have the floor.
Elisa, thank you very much, and thanks to all of you who are joining us this evening. The timing couldn't be better. This has been a fascinating 1 week since the last elections in the United States, and so much has already happened. If we take a look at the financial markets to begin with, it's pretty clear that there has been a robust reaction. Equity prices have moved dramatically higher, and many people would say there has been a positive reaction to the election. And let's put that in some perspective if we can. First of all, there's almost always a positive reaction to an election once it's over. There is greater certainty. Whether people are happy or unhappy with the results, there's less uncertainty in the markets. And in most elections, most people have voted for the winner. We also know, looking at the areas of the US capital markets that have performed quite well in recent days, there are some very specific things associated with the Trump campaign that seem to be well connected. So, for example, many M&A prospects have moved notably higher. The presumption is that the Trump administration 2.0 would be friendlier to M&A activity, would take a less, let's call it a harsher, not quite such a harsh view of antitrust. There's also been an assumption in the markets that Trump 2.0 would lead to lower taxes, or at least to an extension of the tax cuts that were put in place in 2017, and this would be pro-growth. We also see that some other assets have responded as well. So, for example, the surge in cryptocurrency prices seems to be very well connected to the presumption that a Trump administration will be friendlier with regard to regulation of crypto. And in fact, there are some people who were associated with the Trump campaign who even spoke about using cryptocurrencies on the balance sheets of banks or the Federal Reserve. I, for one, think that's not a very good idea, but nevertheless, it's being discussed by many. And then, of course, the dollar rose. So many are taking this as a sign that the financial markets are welcoming the Trump election. However, I think it's important, since we're all affiliated with the business school, and perhaps we need to look underneath the headlines, that we take a much more careful look at some of the other actions that have occurred and some of the nuances going forward. And perhaps the most important thing to keep in mind is that there's a very big difference between a campaign and a campaign promise and actual governance. So what gets discussed during a campaign may or may not happen. Among other issues, one has to have Congress for some of these things actually put together the legislation. And we also, of course, know that there are often lags between wanting to get something implemented and actually having it put into place. There are still so many open questions, including the personnel in the Trump administration. While many people in the media are now lauding the fact that there are a number of positions that have already been filled, or at least the positions have been announced in terms of who will be nominated for them, we've not yet heard anything with regard to the people who might fill the positions as it relates to economic policy, regulatory policy, market policy. And so I think that we all need to take a step back and look at things a little more closely. Can you tell I've become a professor? But this is always the way I've approached my work over the years in terms of analyzing developments in the economy and developments in the market. So let's think about some of the categories in the capital markets that weren't particularly happy the past few days. And at the top of the list, of course, is the US bond market and some other bond markets around the world as well. Interest rates have moved up, not down. And this is despite the fact that the Federal Reserve cut the Fed funds rate just a few days ago. And so we've had a steepening of the yield curve. Yes, very short rates may have gone down, but intermediates and longs have risen. And we have also seen over the last couple of weeks a rise in mortgage rates. So when we think about what are the market reactions, one has to take a look at this and say, there seems to be some concern about what inflationary consequences might result from a Trump 2.0. Now, why would that be? Before I discuss any of that, I want to step back again for one more moment and let's recognize what the stage looks like. Let's set the stage regardless of who was going to win the election. The next administration was going to be taking over a very good-looking economy. So despite all of the comments out there about, oh, the economy is terrible, this is not a terrible economy. The US economy is growing strongly enough to generate jobs and to generate unprecedented corporate profits. Now, we all know that the rate of GDP expansion has slowed from that immediate post-pandemic surge, but we are still seeing real GDP growth that is quite vigorous and seems to be sustainable. So that is one aspect of the good economy that will be in place on January 20th. In addition, inflation has come down, and in many categories has come down very dramatically. While many individuals, many consumers look at price levels and they say, wait a second, it's still very expensive to go to the grocery store, it's still very expensive to buy a new home. Economists look, of course, at the rate of change. We look at the inflationary rate, and that has come down very dramatically. While we know that that was running in double-digit territory during the pandemic and the immediate post-pandemic period, core inflation today, excluding housing, that's a very big exclusion, by the way, excluding housing is actually running at where the Fed says they want it, at about 2 to 2.5%. So other than housing costs in the United States, we have actually seen inflation come under very good control. As I mentioned a few moments ago, we're still seeing good job creation. Now, we're not seeing the kind of ratios we had seen immediately post-pandemic, when there were 2 available jobs for every one worker looking for a job. We're now down to what historically is still a very attractive level of one job available for every one worker looking for a job. So I would say that on January 20th, the next administration is going to have a slate that allows them some flexibility in terms of the sort of policies they wish to follow, because this is not an economy overall in duress. Are there areas where there are problems? Of course there are. I've just mentioned housing expenses. We also know that food costs are high, but that's a global problem. It's not a US problem. And it's hard to see how policy can directly affect the price of eggs if the price of eggs are up because of avian flu. More importantly, we do know that there are significant segments of the US population and some geographies in the United States that believe correctly that they have not fully participated in the recovery in the economy in the post-pandemic period. This affects primarily middle income and some lower middle income areas, and also some rural areas in the United States. And I don't mean to minimize the discomfort that many of these individuals feel, and their problems, of course, need to be addressed through policy. But let's move back and say, over the past week, the stock market has been very happy, basically a vote of confidence that economic growth will continue, corporate profits will continue to rise, and we have seen some rotation in the equity market that I'll discuss later, in which investors are now saying they're willing to broaden out their portfolios. They're looking not just at the so-called Magnificent Seven. But why the problems in the bond market? Why the rise in inflationary concerns? There are a handful of reasons for this. At the top of the list are the proposed tariffs that have been widely discussed by Mr. Trump and have been discussed at great length in things like Project 2025. Mr. Trump and some of his supporters have been talking about across-the-board tariffs. Now, I would say that there may be appropriate uses for tariffs. For example, if another country is dumping a product on the United States or on other countries, as China seems to be doing in some categories where they are producing more than total global demand, then one can see that there is a policy reason to impose a tariff. Across the board tariffs, however, whether they're 10% or the even higher numbers that have been discussed by some, I think many people would view as inflationary, and I have another concern about them. We know, for example, that much of our trade in the United States is done not just with China, but also with our allies in Europe. And our most important trade partners are right here in North America, Mexico and Canada. And to think about imposing an across-the-board tariff there, to me, is very problematic. I also worry about Europe in particular. There are several countries in Europe that may be on the cusp of a recessionary period. We see weakness, for example, in Germany, in parts of Scandinavia and elsewhere. And the analysis that has been done by others that basically says, an across-the-board tariff could in fact ding European GDP growth by something on the order of 0.3 to 0.5 percentage points. If these economies are only growing about 1 or 1.5 percentage points right now, that could in fact be a significant problem. Where else are the inflationary concerns focused? Fiscal policy, of course. Now, we have a fiscal policy that has not yet been defined, right? If in fact there are tax cuts, and those tax cuts go to categories of consumers or categories of businesses that are already doing quite well and are already spending and investing at record levels, those kinds of stimulative activities kind of enhance demand without enhancing supply very much, and many people would conclude that that is inflationary. In addition, we need to think about the potential changes to immigration. Now, I don't think that either party in this election campaign was talking about moving forward with lots of illegal immigration. People are talking about how do you get the border under control and so on. But let's realize that the United States labor force has grown over the years in large part because of immigration. In the 10 years pre-pandemic, for example, 60% of the growth in our labor force came from immigrants, most of it legal. Two-thirds of the working PhDs in the United States in categories including medicine and engineering are in fact immigrants. So when we talk about the impact of immigration on our labor force, let's remember to talk about the higher end of the education and income scale as well as the lower end. Others who have done analysis at the low end of the labor scale are concerned about what might happen to food prices, for example, low-end service prices, and the like. Now, there is much more to talk about, so let me move forward. And if you'd like to address more on this issue or any other, we always have the Q&A session, and I look forward to your questions going forward. One of the concerns that I do have with regard to an incoming Trump administration has to do with the stance on regulation. Now, we all know that there are many areas in which regulation can be improved. That does not mean that deregulation by itself is a good thing. Thoughtful deregulation could be a very good thing, but deregulation across the board could be problematic. Let me give you a few examples. The focus over the last few days in terms of many investors, particularly in the M&A category, the private equity category, basically saying they're thinking, less emphasis on antitrust policy might be a good thing. It may very well. However, if antitrust policy becomes too lax, what history basically says is you get too much concentration in a particular industry. A very small number of participants in that industry develop very significant pricing power. Now, if you are a Columbia CBS graduate and you're thinking, I'm a CEO and I'd kind of like to have more pricing power, good for you. On the other hand, I'm thinking about it from a macro perspective, and we do know that too much concentration, particularly in very strategic categories of industry, can in fact be inflationary and worrisome if we move towards an oligopoly. We also would be looking very carefully in terms of the regulatory stance on things like crypto. Now, I know that crypto has done incredibly well these last few days. The argument in the marketplace has been, we don't need regulation in this area. I would beg to differ. In many aspects, cryptocurrencies are traded and act like securities. And securities, in my view, need to be regulated, especially if we have consumers participating in them who are not, excuse me, among the most well-informed or the most, let's call them the most credentialed of investors. In addition, the discussion about allowing digital currency on bank balance sheets seems to me not to be a very good idea. Normally, what we allow on balance sheets of financial institutions are the lower risk, lower volatility securities. And of course, we've seen, for example, in Bitcoin, just over the last few days, while it's happy volatility, it nevertheless is volatility and could move in the opposite direction. I would also remind everyone that when volatile assets are allowed on balance sheets, you have to put up, that is, the bank has to put up a very significant amount of capital against it. Think of it as a very significant haircut. And in the case, pardon me, in the case of the volatility that you might be seeing with regard to crypto, we would have a situation where we could have haircuts of as much as 90%. So let me move on and discuss one more aspect before we move into Q&A. And I'm also going to address markets, but one more macro issue, if I may, and that has to do with something called Schedule F. Now, Schedule F has to do with employees in the federal government. At the end of Mr. Trump's first term of office, something called Schedule F was in fact put into place. And what does this refer to? Well, every administration, of course, has its political appointees across the federal government, not just in Washington, but throughout the country. There are roughly 10,000 of these individuals who get selected by the administration, and they head up various agencies and so on. Under Schedule F, as it was put forward under Trump 1.0, those 10,000 positions would remain political, but the 40,000 or so positions underneath that area would also become political appointments rather than civil service appointments. Now, why is this something that concerns me? Well, those 40,000 or so positions are typically filled by subject matter experts. This is where the scientists are. This is where the experts in a whole variety of other categories of things basically participate in helping run our government. And I do worry that if subject matter experts are replaced by political appointees who don't have that level expertise, we could in fact be harming ourselves in the end. I'm particularly concerned about some of the science areas where Mr. Trump was not happy with some of the agencies last go round. He, for example, in his last couple of years in office, proposed very dramatic reductions in things like the National Institutes of Health, the National Science Foundation, and so on. Interestingly, it was Republicans in Congress who restored those budget cuts. And so I think that when I ponder what could happen intermediate to long term, what I very much focus on is the macro policy that would stimulate growth, not necessarily right away, but intermediate and longer term. So, for example, spending on public infrastructure, roads, bridges, water systems, something that began during Mr. Biden's term of office, much of that money being allocated to Republican-oriented counties throughout the United States. Another area in which the US government has spent money on basically providing long-term assistance to basic research, including in things like technology. Obviously, the CHIPS and Science Act. We now see, for example, that there are semiconductor fabs that are under construction throughout the United States, most of them, again, in Republican areas of the country, creating jobs for middle-income workers. You don't have to be a high-tech worker to benefit from this. So the construction and operation of these facilities will be enormously helpful. I also think it's important to recognize one other aspect. One piece of legislation that I think has gotten an unfortunately bad rap and doesn't deserve it has to do with the so-called IRA, the Inflation Reduction Act, that was passed with some bipartisan support in Mr. Biden's administration. And Inflation Reduction Act, because some pharmaceutical prices are capped and kept under control. For example, I'm sure you've all heard of insulin prices being capped at $35 a month for people who need to use it. But we also have under the IRA significant new cap spending in sources of energy. And it's not all the alternative energy that some people like to criticize. A lot of it has to do with enhancing electrical generation, something that we're going to need, obviously, in this economy that is increasingly dependent on technology, including AI and other things that consume a great deal of power. So before I stop, and take questions, what I would like to do is to speak just for a few moments about what we're seeing in the equity market. Obviously, a very powerful rally over the past week or so, a lot of it fueled by enthusiasm about a pro-growth environment, enthusiasm as well about corporate profits that continue to be gangbusters, and guidance from corporations that remain quite favorable. And one of the fascinating things to me has been this rotation within the equity market. Until just a few weeks ago, it was the Mag 7 that was driving everything, the concentration of market capitalization, the concentration of profit growth within the S&P 500, for example, very much Mag 7, taking over something like 30 to 35% of the total. Over the last week or so, we're seeing a movement into other portions of the equity markets. This includes other S&P 500 stocks, let's call it the S&P 490, that is doing better than it had previously. We're seeing a movement away from the so-called growth names into the growth and value names, or the value names. If interest rates have moved higher because of their concerns about inflation, all other things being equal, that hurts the valuation of those stocks. I'm sure you all remember your valuation models, and you remember that inverse correlation. Now, we may get very lucky, and the rise in interest rates may get offset by very strong profit gains. But clearly, what many investors have been doing recently is looking at the gaps that have developed with regard to relative valuation within the equity market and saying, if profit growth is going to be okay, but not fabulous, and interest rates have risen, let me diversify my equity-oriented portfolio in this manner. We also see greater interest in small and mid-cap names, and there the hope is that they will benefit from availability of capital, and they will, importantly, benefit from an extended, protracted period of economic growth, which ultimately is the best tonic for all economies. So I'm going to stop there. I've left ample time for questions, and I look forward to it. Elisa's going to let us know what some of those questions are, and let me just turn it over to you now.
Okay, great. Let's transition to Q&A. Thank you, Professor Cohen. All right. So we have a question that came in from Jeffrey Wu, and he asked about your thoughts on the price trend of gold and RMB currency.
Yeah, so I am not a commodities analyst, and so I prefer not to speak about a gold forecast or anything of that sort. Typically, when there are inflationary concerns, gold does better. Over history, however, investors are usually better served looking at gold as an industrial commodity. It is needed in electronics, it is needed in some automotive product, and so on. So let me just stop talking about gold right there. In terms of renminbi, very important question. I think many people recognize that going forward, there are two major economies. There's the United States and there's China. Now, on a real GDP basis, the US economy is still much larger than the Chinese economy. And clearly on a per capita GDP basis, how much economic wealth is there? I'm not talking about portfolio wealth, but how much economic wealth is there per person? The United States remains a far wealthier nation. However, China is on the march. And this is a long-term set of trends we need to be looking at. In the short term, what we have seen is that Chinese growth has been disappointing since the pandemic. Very simply, one reason for it is that the Chinese opted not to use the globally accepted vaccines, which have been developed mainly in the United States, but also in Europe, that had very good efficacy. I think you may all recall that the efficacy for the COVID vaccines that we had access to were 85 to 90%. The vaccine that was developed in China had an efficacy rate that was closer to 20 to 25%. And they didn't want to use any of the global vaccines. So what did they do? They used the public health measures that had been used in prior centuries. Yes, I said centuries, which was basically quarantine and shut down the economy. And they have had a hard time getting back on track. In addition to that, the Chinese economy was also highly levered. There had been easy access to capital and liquidity. There had been an overbuilding in many categories, including real estate and, unfortunately, residential real estate, where many households overparticipated, something very similar to the financial crisis here in 2007, 2008. And the Chinese have had a hard time breaking out of the cycle. Now, they have tried a variety of different stimulative methods. There was something announced just a week or 10 days ago. It initially got a positive response, then it got a negative response. And back to your question, it has an impact, obviously, on renminbi, the currency of the Chinese economy. And let's remember that a currency is a relative price, right? The currency doesn't go up or down by itself. It goes up or down relative to something else. And the dollar has been strong, and it has been strong relative to renminbi. And of course, the opposite is true, right? Renminbi has been weak relative to the dollar. Looking out long term, however, the Chinese are continuing to plug away, making long-term investments in their economy. What are they doing? They're investing very heavily in education. They are graduating untold numbers of engineers and scientists every year. They have increased by tenfold the amount of money that is spent by the Chinese government in basic science and research. The United States used to be number one in this category for more than a century, not just in terms of how much we spent on basic science and research, but how much we spent as a percentage of our GDP and our federal budget. In the 1960s, by far, number one in the world by a huge margin. Do you know where we are now? We're number 12. So while we have de-emphasized this kind of long-term investment in our own economy, the Chinese have really stepped it up. By the way, some other economies have done so as well, following this kind of industrial policy. This would include South Korea and Scandinavia. But getting back to China, I think we still need to watch very carefully. The Chinese are now asserting themselves more as well on the military front. And by the way, their space program is a military program, right? Whoever has the higher satellites, whoever has more facilities up on the moon, they have a better line of sight for military and for other purposes.
Our next question is from Stephen Doherty. Stephen says, thank you for this discussion, Professor Cohen. Do you have an idea of which tariff might be first, China, Mexico, or EU? And also any thought on retaliation in form of tariff or trade restrictions?
Yeah, those are wonderful questions, Stephen. And to be honest, I can't answer them with any specificity or any confidence, but let me take a crack at it. I believe that if you have similar people in the USTR as we had in Trump 1.0. So, for example, Robert Lighthizer taking over trade policy again, then I think you're going to see a great deal of focus first on China. Uh, Even the Biden administration has been focused on China, trying to stem some of the dumping activities. So I would say that that's where you should be seeing it. I would hope that we are kind to our neighbors here in North America. Let's keep in mind the following. A car that is produced in the United States actually has parts of that car go back and forth over the borders to Canada and Mexico on average roughly 12 to 15 times. It depends upon the make of the car. Because even if we say something is made in Detroit, a lot of it's made in Windsor, Ontario, or it's made someplace in Mexico and gets assembled in Detroit. And I think that aggressive tariffs here in North America could hurt us as well as the nation that it is targeting. And I'm assuming everyone on this call knows that the nation that is targeted doesn't pay the tariff, right? The tariff is ultimately paid by the end user of the product, and that end user is often a consumer based here in the United States. Now, you also asked about retaliatory tariff, and that's where it gets really messy. We can do the analysis, and some firms, some brokerage firms have, in terms of, what would the impact be on Europe, on Korea, et cetera, if in fact the United States imposes a tariff. What about the next step? What if they impose tariffs on us? And the answer is we just don't know. Last time around, the tariffs turned out to be highly selective, often on things that didn't matter very much to the average consumer. So you may recall at one point the United States put tariffs on very expensive French wine. They were making a statement, but didn't really have an economic impact on most Americans. So we really have to wait and see what happens. I just hope that the people who focus on trade policy in the Trump administration also recognize that the countries in Europe are dealing with their own slow growth right now, and they are also very important military allies of the United States, and it would not be in our interest for them to have more economic woes than they have right now.
Hey, our next question is from Umberto. He says, Abby, you spoke of residential real estate. What is your impression on the commercial real estate market, occupancy rates, and the implication or impact on regional banks and their balance sheets?
Commercial real estate is one of those things that takes years and years to work through. And the reason, of course, is that the leases on CREs can be 7 to 10 years. Much depends upon the region of the country. And so what we're basically seeing is that in several cities, several municipal areas, metro areas rather, things are working out more smoothly than had been feared. But that doesn't mean it is clear sailing for all. So here in New York, as I'm sure many people are aware, Class A commercial real estate is doing extraordinarily well. There's enormous demand for the best buildings in the city, and where the problems exist are in the lower quality buildings, because businesses have moved out of them. They've been able to move into the Class A buildings, and we have that kind of uneven situation. We also know that CREs and the problems thereof in various metro areas have created enormous problems for small and mid-sized local businesses. Think about the retail establishments, the restaurants, and so on. The thing that, of course, is important to keep in mind is that with leases of 7 to 10 years, we have not necessarily seen the full accounting reckoning that we'd like to see. Now, some real estate owners have been much more forthright, have marked down the value of their assets in a pretty proactive way, but others have not. And this is an area of some concern. By the way, I would say this is also an area of concern in some pools of private investments, because we just don't have the sort of visibility we might like in terms of whether the appropriate haircuts have been taken.
We have a question from Robert. He writes, "We are living in a very volatile international environment. What can you say about the potential impact on the global economy if the US is drawn into a significant military engagement?"
This is something that is not my area of expertise, quite frankly. And I would say that we as citizens should all be very concerned about this sort of thing happening. But again, I'm not an expert on military matters. What I would suggest, Robert, is if you take a look at the website of the Council on Foreign Relations, which over the last year or so has published a number of very thoughtful articles about just this issue. You know, what would happen if the US would be drawn in to such a circumstance? I'll give you a couple of the points that have been made there, which is not likely to happen because what we have seen thus far are more regional than anything else. But number two, that doesn't mean going forward it wouldn't happen in the years ahead. And a lot of the focus on the part of people who do look at political strategy, military strategy, geopolitical concerns, and so on, look at the alliances that are being formed as we speak. With North Korea now fighting in Ukraine on behalf of Russia, with military armaments being provided between Russia, Iran, North Korea, and so on. These are areas of concern. And of course, the big question mark is China. And, you know, how would they participate in any sort of potential regional conflict? And the focus is on what about Taiwan? And this is well beyond my area of expertise, so I'm going to stop talking right now.
We have a few questions that have come in about the national debt and suggestions on how we can diminish some of that under the Trump administration. Any thoughts, Professor Cohen?
Yeah, you know, one of the disappointments in recent years has been the following. Other than that very sharp but brief recession during Mr. Trump's administration because of the pandemic, we've had an economy that has grown quite well. And normally we would see that the deficit as a percentage of GDP would shrink under such circumstances, but it hasn't. And we now have those kinds of ratios that are concerning, because if we can't get the deficit and debt down as a percentage of GDP when the economy is doing well, you know, what are we going to do when the economy doesn't do well? Some of the analyses that have been done using Mr. Trump's campaign promises don't bode well in this regard. Now, I'm going to go back to the point I made earlier. There's a very big difference between a campaign promise and what is actually implemented as policy. But the numbers that I have seen basically say the deficit, roughly 6 or 7% of GDP, would go up to something on the order of 10 to 12% of GDP, even with economic growth. Now, Again, I have no idea who the economic policymakers are going to be in Trump 2.0, and I certainly don't know what the new policies are going to be. I'm just providing those parameters to you, basically saying it's something that has to be watched, and I believe watched carefully. If we go back in history and say, how do nations get out of this kind of bind? There are two ways. There is the happy way, and then there's the sneaky way. The happy way is to grow. The happy way is to have economic growth, to have labor force growth, to have productivity growth, and therefore to have GDP growth, which is sufficient so that incomes grow, profits grow, ultimately tax revenue increases accordingly, and the need for counter-cyclical spending, such as the counter-cyclical spending we saw during the pandemic, simply won't be needed. And that's the happy way to, on a multi-year basis, get you out of the problem. Something that some nations have done is to inflate their way out of the problem. Because if you pay back your debt with dollars which aren't worth as much as they were when you initially borrowed them, that's the way some nations have gotten themselves out of debt. It's not a great thing for us to be thinking about, but it certainly is something that theoreticians propose. Doesn't have good consequences on the currency, doesn't have good consequences with regard to capital flows being attracted into the United States. Let's keep in mind that we are a magnet for capital from around the world. And it's not just into our treasury market where we see a lot of foreign participation. We are also a huge magnet for foreign direct investment. Yes, companies from around the world want to invest. They want to build facilities here in the United States. They want to start companies here in the United States. And if we show that we don't have our inflation under control, we're not serious about budget issues and so on, that is problematic. And by the way, let me make the following statement to be clear, and that is spending by the government, just knowing the number, is by itself not enough. You need to know what it's being spent on. So, for example, what we often refer to as a tax expenditure, some people would call it a tax cut, if it doesn't go to stimulate long-term growth in the economy, it usually is not worth the effort because it's sort of a short-term sugar rush. Instead, what does benefit the United States are the sorts of long-term investments that we saw, for example, in the late 40s and early 50s, spending on public infrastructure, spending on public education, and spending, as I mentioned before, on basic science and scientific research, because that's what ultimately gives you the productivity gains that ultimately give you the long-term economic growth.
We have a question from Peter England. He writes, do you think the Fed will be able to maintain its independence in this administration?
I certainly hope that it can, and I hope that it does. I began my career as a very junior person at the Federal Reserve. And at that time, there was a chairman who bent to political will. And the results years thereafter were very problematic. I think that we need a Fed that is independent and a Fed that has credibility. So much of the efficacy of Fed policy is not just what they do, but people having confidence that what they will do will be successful. And if you damage the independence of the Fed, then I would be concerned about that.
Our next question says, thank you for sharing your insights, Professor Cohen. This is an outstanding assessment of the global environment and its dynamic. What advice would you have for senior leadership at global financial services institutions?
Well, global financial services institutions is where I spent most of my career. And so I do have a few thoughts. Number one, most of the senior leaders that I speak to there do not favor deregulation of the financial services industry. What they favor is thoughtful regulation. Because keep in mind that while capital constraints have risen under the various new Basel Accords and so on, one of the big worries that major firms often have is counterparty risk. And so the regulation is not just on me, Bank A, but the regulation also gives me confidence that banks B and C know what they're doing, and they're reporting out their assets properly. So I believe that large financial institutions, global ones, have learned many lessons in recent years. They have become much more careful following the GFC, the global financial crisis. Many of them became even more careful more recently following the problems in places like Silicon Valley Bank. But one of the things that has been pleasing to me, quite frankly, is that there have been so few of these instances of problems. And I think it's an indication of, yeah, the regulators perhaps are doing a good job, but I think internal regulation has also been very effective, and I'm very pleased about that. So that's one thing to keep in mind. I believe that there are many growth opportunities for global financial services companies. I do not believe that globalization has ended. I just think that globalization is getting smarter, and financial services companies know where their opportunities are in terms of where other large companies want to do business and need to provide the services for them in so doing. And I have confidence that this particular sector of the equity markets, which have basically not performed as well as some others, have recently shown renewed vigor, and I think it's warranted based upon the profit outlook.
Edward Kane writes, speaking of tariffs, with Trump's plan to impose 60% tariffs on imported goods, won't this cause higher prices for US consumers and ultimately inflation?
Yes, clearly it will. Tariffs are inflationary. To come up with a number like 60%, I'm not quite sure where that came from. But if this incoming administration applies tariff and other trade policies thoughtfully and carefully, perhaps warning of a 60% tariff or whatever the number is, can have a beneficial impact in terms of encouraging better behavior on the other side. And again, I would hope that tariffs be used in a very careful manner, be used in situations, for example, where there's dumping, but not be used in a general across the board manner.
Great. Okay, we have a question here from Judy. Is there a level of debt to GDP where the US could experience a Liz Truss moment?
That has been a great question for the last couple of weeks. And the answer is not quite as simple as just the number. The answer also depends upon the outlook for the currency, and so on. And one advantage the United States has that Ms. Truss did not have is that the US dollar is in fact the world's reserve currency. Pound sterling used to be the world's reserve currency, and at that point, the British could do pretty much whatever they liked. They had a lot of margin for error, just the way we do right now. So no, I don't think that there's a Liz Truss moment coming anytime soon. However, if over the next small number of years we don't show that there is a willingness to take this trajectory seriously, then I think we could be running into problems where interest rates do move higher on a sustained basis. The dollar is under more pressure on a sustained basis. And we have to remember, of course, the demographic time bomb out there. I don't want to take personal responsibility for it, but all of us baby boomers, pretty large category of people. The median baby boomer was born in 1957, which means that there are now more baby boomers collecting Social Security than not. And then, of course, there are Medicare expenditures. By the way, Medicare expenditures have gotten are better controlled than we might have hoped for a few years ago. The ACA, Obamacare, actually did bring healthcare inflation under control. And of course, Medicare revenues are scaled much higher than our Social Security revenues.
All right, so we're going to wrap up Q&A. That was our last question. Thank you. There were so many questions submitted. We really appreciate it. We had over 250 attendees tonight. I want to give a tremendous thank you to Professor Joseph Cohen. This was incredibly informative and such a timely topic. Thank you also to everyone who tuned in. We are so thrilled that you chose to spend a little time with us. I would encourage everyone to join us again virtually for our next CBS Faculty Live virtual talk. Our next talk will be with Professor Nee on his book, The Platform Delusion, and that will take place on November 18th at 1 p.m. Thank you all. Thank you again, Professor Abby. This was a real treat. So we're going to close out now, and we will share this recording post-event. Have a wonderful evening, everyone.